Obviously, we're going to be watching today what's happening out in Jackson Hole, Wyoming. Federal Reserve Chair Janet Yellen and other central bankers are going to be gathering to assess the global economy at that annual conference. Sean O'Hara, president at Pacer ETFs, joins us now. Sean, good morning.
Good morning, Cheryl. How are you?
Good. Let's talk about first what we're going to hear, what we expect to hear. You're going to Mario Draghi there, ECB president. You've got Janet Yellen. Central banks around the world have been giving out lots of easy money. You say that they're kind of behind the curve and that the U.S. is really leading when it comes to how to basically facilitate a strong economy through easy money.
Well, I think that's been the case here in the U.S. for the last several years. If you look at U.S. equity prices and how correlated they are to the size of the Fed's balance sheet, there's a pretty high correlation there. So I think we're just a little bit ahead of where Europe and Japan are in particular. I think there's a lot better environment for equities if you believe easy money is going to drive equity prices higher outside the U.S. right now. The big question I think that needs to get answered on the Fed side is what do they do with the balance sheet now and how do they unwind it in a way that's not totally disruptive?
Well, let's talk about that, Sean, because, you know, it's widely believed that in September, we've gotten some hints already from the Fed minutes and from the meetings, that September is the month. That's when the unwinding of the balance sheet is to begin. Do you think it's going to be disruptive to U.S. markets, or do you think that investors are ready to see the Fed kind of, you know, get out of the U.S. economy a little bit, if you will?
Well, I think they've kind of sufficiently tipped their hand, if you will, so I wouldn't expect them to do anything that is completely disruptive. I do think they need to start winding it down, and I think they need to do it in a way that is orderly and that the market sees. The interesting thing will be whether or not you actually see real price discovery going forward. You know, you've had sort of an indiscriminate buyer for the last 4 or 5 years here in the U.S., and when you remove that indiscriminate buyer, I think that'll give the market an opportunity to do real price discovery, which I think is healthy more than hurtful.
Well, I think, you know, so many analysts, yourself included, have said it's time to see the real market and the real economy. More importantly, that, you know, the Fed came in, of course, after the Great Recession, but they couldn't have stayed there forever. They probably stayed a little bit longer than many expected. Let's talk about overseas investing. So one of the things that you're telling your clients right now is that it's not, that we should maybe start to look for overseas emerging markets, first world market investments, and not be so U.S.-centric. What are you seeing that we don't know about yet?
Well, we're seeing outside of the U.S., in particular in Europe and Japan. And by the way, if you weren't paying attention, you missed the fact that, like, Europe, I think, is up more year to date than the NASDAQ 100. So we spend a lot of time here in the U.S. talking about the NASDAQ 100 and the performance that's been generated there. But I think Europe has done better year to date than the NASDAQ. So, and there's a reason for that. The reason are probably twofold. One is that there is, like, more aggressive monetary policy still in place there. I think that, you know, Draghi and I think in Japan in particular, the Abe are very committed to what they're doing. And that's obviously a big part of it. And then the second thing is that for the last 5 or 6 years, I think investors here in the United States have been overweight U.S. equities and are starting to now move their portfolios back to the point where they're more in line with their traditional.
But there's still some U.S. stocks that you like, Sean. There's still some U.S. stocks that you like, and they're names that we know. These are great American companies we follow. Boeing is one of your big picks, of course, trading on the New York Stock Exchange. And you say that, you know, the 737, the 787, this really shows that this is a strong company to invest in.
Yeah, we have a whole series which we use free cash flow yield to screen indexes by, and Boeing is one of those companies that screened in here recently and has been a terrific holding for us. Their operating model continued to be very strong, but the stock price sort of got hammered a little bit, if you will. It's come back, way back so far this year. But we look for companies in our cash cows via our screen that have good free cash flow and good free cash flow yield.
Right.
And oftentimes you get to buy stocks at a discount to what their real value is.
You also like Rio Tinto, you like Sony, so a lot of names that you're following. Sean, it was great to have you on the show. Thank you.
Thank you so much.